From the library of the New York Stock Exchange at the corner of Wall and Broad Streets in New York City, you're inside the Ice House, our podcast from Intercontinental Exchange on markets, leadership, and vision in global business. The dream drivers that have made the NYSE an indispensable institution of global growth for over 225 years. Each week, we feature stories of those who hatch plans, create jobs, and harness the engine of capitalism. Right here, right now at the NYSE and at ICE's exchanges and clearinghouses around the world. And now welcome inside the Ice House. Here's your host, Josh King of Intercontinental Exchange.
The role of the chief financial officer has evolved over the past decades. It's a job that's no longer focused only on building a fortress balance sheet, as Jamie Dimon came to calling it. A modern CFO has his or her hands on many levers of the organization, overseeing the function of everything from long-term strategy to data security and everything in between. Here at ICE, we just made a pretty big announcement. Our longtime CFO, Scott Hill, who was our guest here inside the Ice House back on episode 105, said he's going to retire after 14 years in that job as of May 14th, to be succeeded by my friend Warren Gardner, who has served as ICE's head of investor relations since 2017. Warren has big Texas shoes to fill, and the good thing is he knows it. Scott joined ICE back in 2007 when it was a much smaller company. I checked the stats today. The company's share price started in the 20s that year, and this week it's at around 114, and Scott's played a big role in that growth. One data point I know he's proud of is as a revenue multiplier that saw $574 million in the first year become over $6 billion in 2020. Scott's a great example of how a CFO is responsible for more than just finance, accounting, audit, control, IR, and tax. During his tenure, he was at various times overseeing our global clearing business, human resources, marketing, PR, and other areas of the company. He's also part of the small leadership team that saw ICE make its most high-profile acquisitions, including the New York Stock Exchange in 2013, Interactive Data Corporation in 2015, and our biggest deal yet, buying Ellie Mae in 2020 for $11 billion. Our guest today on the show, Ken Goldman, the president of Hillspire LLC, is part of that elite group who has risen to the rank of CFO of a publicly traded company. Not once, but by my count, 9 times, spanning a career at that level that goes back to when George H.W. Bush was the 41st president of the United States. And if I'm wrong on that number, he'll correct me. Each company part of the pantheon of technology names that have made Silicon Valley what it is today. Our conversation with Ken Goldman on his career, building elite leadership teams, and the growing role of family offices in the investment community. That's all coming up right after this.
Whether it's markets, exchanges, or networks, connection makes everything possible. The connection between data and technology, innovation and expertise, and most of all, between people and opportunity. For over 20 years, ICE has transformed markets, products, and processes to make things work better, faster, smarter. From modernizing energy and commodity trading to revolutionizing the bond markets. Whether it's the world's largest stock exchange or the dream of home ownership, we do more than see the big picture. We create it. You may not know our name, but we bet you know our network. ICE. Make the connection.
Our guest today, Ken Goldman, is president of Hillspire LLC, one of the most active family offices in the world. At Hillspire, Ken is responsible for its financial and administrative functions, along with real estate, aviation, and maritime activities. Previously, he held the CFO role at a number of companies, including Yahoo, Fortinet, and Siebel Systems. And during a professional career spanning more than 40 years, Ken has helped take 3 companies public as its CFO and served on 40 corporate boards, of which 10 of them have gone public while he was a board member. Ken, welcome inside the Ice House.
Josh, I don't think that you didn't leave anything for me to talk about. You did all my bragging for me, so that's great. I've actually been in 7 public companies, not quite 9, but the 3 IPOs were 3 different decades, and I was thinking I could make another one, but I'm not sure I want to give up some of my personal freedom that I have now in terms of my calendaring that I would have to give up to be a CFO. But happy to go wherever you want to go on this conversation, and thank you for the introduction.
We got many more things to brag on you about, Ken. Over your career, you've served as CFO for several companies, as you said, at different stages of development over the course of 3 different decades. We've got a new CFO taking the reins in May of a company that's been public now for 15 years. What advice would you have for my friend Warren Gardner as he fills Scott Hill's cowboy boots?
What I've always found is there's always a couple of things. One is you have to realize, as much as you might have said some nice things about me, you're really only as good as what you do now. And you have to sort of always be in a position to prove yourself and show that you do add value. So what I always look for when I change jobs, and I'd say the same thing here, is find some things where you think you can add some value. In the case of Yahoo, which unfortunately doesn't exist as we know, it was acquired, the operating business acquired by Verizon. There's a few things that I saw there that really weren't very well done. And I'll start with just who approves what. We had a system there where the only things that came up to the CFO to approve were $5 million and over. And I said, this makes no sense. I went from $5 million to $100,000. Did that for a number of reasons. One is I need to know, I think it's very important for a CFO to see the rhythm of what's going on in the business. And so one of the ways you see the rhythm is you see things to review and approve. And I might not necessarily reject anything, but it gave me a sense of where the money was flowing. And so it was very helpful. Second of all, by looking at that, I found areas where I could help negotiate because I have a lot of experience, been around a while, and I have a sense of how to negotiate. And sometimes the best negotiating is just asking a number of questions. The other thing I have tried to do in my career is align myself with the operating people. I think sometimes CFOs spend too much time with investors. And what I like to say is that it's very simple. Investors love you when the numbers are great. And when the numbers aren't great, it doesn't really matter how great you talk. So you want to really focus on the operating results of the company. That's where I happen to, that's how I grew up in finance. I like being very close to the operations. And so I spent a disproportionate amount of my time on that. I would say another thing to think about is making sure you have alignment with the board. It's very important for the board to feel the CFO is someone they can trust. Very, very important. And so getting to the trust of the board that they know you call it the way you call a spade a spade. You don't necessarily countermand your CEO. On the other hand, you do have an independent fiduciary responsibility to give your own opinion. So managing the board relationship, very, very important. Last thing I'll say is getting really close to the auditors. So yes, the role has changed of CFOs. In the old days, you would never see folks coming out of investment banking going into CFOs. They're now doing that a lot. So yes, the role has changed. However, you need to ensure the basics are there. And so making sure that the controllership function is rock solid and internal controls are really good. So making sure whoever your audit partner is, being very close to them, and so they have confidence in you and vice versa. Those are some of the things I always say, really, basics, and basics matter.
We're going to course through your career and learn some lessons along the way. But first, I just want to get your reaction to some of the trends we've seen over the past year. I mentioned that Scott Hill is from Texas. There's been a big migration from your adopted home state of California to the Lone Star State. McKesson was one of the early names making that move. Tesla, one of the latest. You're a Boston guy, Ken. What does California need to do to hold on to its tech talent?
I was just on a call before this with a friend of mine who used to be in California. He's now in Jackson Hole. A couple other people he mentioned that I know are also now new residents of Jackson Hole. I have a bunch of buddies that have moved to Colorado. I know people who moved to Texas. I know people who moved to Florida. And I actually was listening to, a conversation with the mayor of Miami, of all things.
Mayor Suarez is all over the map trying to get everyone come down to South Florida.
Well, I'll tell you, he said a variety of things. But, when you say, what do we need? Sometimes just having appreciation for business and for being thankful of business and not being arrogant about business is helpful. When someone told me, I asked them why they were leaving, they said it wasn't so much the taxes. It was the words they used were it was a narrative and governance of the state. And so being business friendly, opening your arms up to people who have done well and not necessarily, applauding them, but appreciating them as opposed to demonizing them. We have an approach here lately that we sort of demonize people that have been successful as opposed to appreciating people that have been successful. I think, believe it or not, that goes a long way. Sometimes even as much as the tax strategies, some of that strategies. Texas has their arms out, bringing people in. Florida has their arms out, bringing people in. It's a welcoming environment. Well, I would lie if I say taxes don't mean something, but most of these people are so well off. I think people are more than willing to pay their fair share, more than their fair share, as long as they feel appreciated. And two, I might add, if they feel the money is being well spent. You go to Florida, actually going to be in Florida next week, things work. The DMV works. The roads are in great shape. I mean, it's just a well-run state. I was listening to the mayor. He said they only have 550, 550 is probably 550 too many, but they only have 550 homeless people. We have 550 homeless people on a street corner in San Francisco. Now, what you want to do is you want to create shelters for them. You want to create food for them. You want to create healthcare for them. I think if you tell people you need to spend X, Y, Z to make sure these people that have been left behind have a home, have food, have basic necessities, all in. I just read where the Bloomberg philanthropy is creating just gave $100 million to Harvard, Kennedy School and the Business School to study and support the great mayors, because that's what, great mayors create great cities, and they help create great states and so forth. And we have lost track. In my opinion, we have lost track of a lot of that in California. What's keeping California afloat, so to speak, is we have a critical mass of very smart people. We have the venture community here. We have the lawyers. We have the bankers here. We have a great climate. We have a critical mass to keep it going. But we certainly are not doing everything we can to support those people that want to create companies here.
In addition to all that, Ken, you also have a lot of family offices in California. And over the course of our 225 episodes of Inside the Ice House so far, you are our first family office president on the show. So let's start there. And depending on the study, Ken, between maybe $4 and $6 trillion in assets are now managed by family offices. What's so appealing about that structure that it's seen such growth?
And I've gone to a lot of family office conferences. Actually one that's has been very good. Citigroup has done really great in terms of how they support family offices. But as I've been sort of getting a little bit more focused on this, I've learned that there's no basic set approach for family offices. They're all run, I shouldn't say all, but there's different ways to do it. Some may be focused just on the investment side. Some may be just focused on the philanthropy side. Some may have certain aspects of the family's activities, including their personal properties or whatever they have. But it just differs. In the case we have, everything of the family is inclusive of our family office. But there's others where they may segregate certain aspects. I know a good friend of mine, his family office is basically just focused on investing in philanthropy. And we have a very large group. I have a lot of direct reports. I have a very, very, very senior group of competent people who work in the group with me. Some of them work, directly for me. Some really work effectively for either Eric or Wendy directly. And it's just a great group. Great group.
Back in May, Ken, you said that the asynchronous nature of remote work is not going to be sustainable, a view that really is shared by many CEOs. Have you begun to transition Hillspire back to Alma Station, and has your thinking on remote work evolved now that we're really entering year 2 of the pandemic as of this week?
Well, it's an interesting question. We actually have a meeting weekly with a senior group to discuss this. I think the world's different. I think whether you use any of the video conferencing products, Zoom or whatever, you bring Central in terms of a board that I'm on. We have a great video conferencing product. The world today is much more amenable to being able to connect via video conferencing. And so the idea that you'll I'll go to New York to go for a 2-hour meeting and come back, I just don't see that happening. However, we do believe, and we've actually had this conversation that we are better off by being in the office more than otherwise. We have also said that we're going to basically want people to have a vaccine before they come back. I guess the good news and bad news is I'm old, and the good news of that is I've now been vaccinated, so I can go out and I can go out and party. But we want people to be vaccinated. Are we going to require people to be all in the office 5 days a week? I doubt it. We will create calendar flexibility. We do believe we have nice offices. We do believe people should be in the office, as much as possible. But I don't see us. I just can't see us saying you have to be there 5 days a week. I think some of these companies have been too quick to say they will allow 100% remote some of the employees. I don't think we quite know what how comfortable we will be with our future habits until we see it work. They'll have the best of all worlds. They go back to a lot of the good habits they liked, but where they don't need to do, as I said before, an hour or 2-hour meeting to go from San Francisco to New York, they won't do that either.
Over your career, Ken, you've seen countless number of challenges like this, good and bad, hitting the economy. Eric Schmidt himself was instrumental in advising President Obama as he navigated the worst days of the financial crisis back in 2009. As you see the world starting to turn the corner on COVID, as you get your vaccine, do you have a sense of what the recovery is going to look like overall?
Well, yeah, just to sort of add to what you just said, Eric was also involved in reimagining New York and how to reopen New York and how to make New York better coming out of the virus. And, that's the old saying, don't waste any crisis. So how can we come back after the crisis in a better than we were going in? I would say, here's the yin and yang to your question. And I actually had an internal, disagreement a little bit as to how different people think. I think the yin part is there's a lot of pent-up demand. We've given a lot of stimulus to people, which I think in terms of giving money to people that are down on their luck, so to speak, because they go, I'm all for. On the other hand, I think we're going, in my opinion, we're going too far on some of the state and local and stuff. Yes, there's slack in the economy for labor for now. You see a lot of demand, desire to increase the minimum wage, which I get. So I think you have humongous budget deficits at all levels. So I think you're going to see interest rates go up. At some point, I think you're going to see inflation go up. And we've talked about that for 20 years, and some people disagree with me and say, no, we've talked about inflation going up for 20 years and it hasn't happened. But I think two things, the big deficits, budget deficits, and the humongous pent-up demand. I see the seeds of inflation coming back. You see, as I said earlier, you see that on oil, and many other commodities are at a very all-time highs as well. If I would put my worry hat on, my worry hat is on interest rates. I said this a few weeks ago, and and this is all public. We did a investment grade debt for Fortinet, just a couple of weeks ago, and really picked a good time. And the 10-year Treasury was 137 or 136. It's now 155. Mortgages are over 3% now. 30-year mortgages are over 3%. So those are concerns, I think, is whether we're going to create competition for investing dollars with debt costs, and therefore that will come against, that will, A, will stop the great housing recovery we have, and B, it will, it'll affect the stock market. And reality is stock market and consumer confidence are so correlated. I think if the market goes the other direction, that has a direct correlation to consumer confidence.
You've been wearing that worry hat on and off throughout your career, Ken. After growing up in Peabody and getting degrees from Cornell and HBS, you headed west, young man. What initially brought you out to California?
I was an engineer at Cornell. I was an MBA focusing on finance at Harvard. And just to sort of add to something you mentioned, you're from Newton. I went to public schools in Peabody, graduated very high in my class. I think maybe 15% of my class it was a blue collar town, went to college. So I wanted to go to the best school I could possibly get into that had engineering and liberal arts, and that was Cornell. And so then I had, when I graduated HBS, I remember this like it was yesterday. I interviewed a lot of different companies, oil companies, Xerox in Rochester, New York, and then Fairchild, which was out in the West Coast. And I just had this, streak of risk taking to me, which said I owned nothing. I had an old car that was to my name. I knew one person out here. And I said, geez, why don't I go into technology where I can combine my engineering background with finance? I'm not a salesperson, so banking is not my gig. I looked at for those on this call that know Boston, Route 128, back then that was the epicenter of technology, but for whatever reason, I felt that Silicon Valley would be the place to be. I happen to like semiconductors. That was one of my focus areas in engineering school. And so I said, why not come out? And here's the point, a couple key points. One is the guy that interviewed and hired me was a corporate controller at Fairchild, Henry Montgomery. And the fact that someone at his level would take the time to meet and interview me made a big difference to me. And by the way, which I continue now. And so I love talking to students and hiring and recruiting students. I think, I actually would talk to a group of Northwestern MBAs the other day. And so I really enjoy explaining to them how excited I am about the CFO corporate career. And so the fact that this guy, Henry Montgomery, took interest in me, felt was a big deal. So we hired 3 interns. Actually, one of the interns just reached out to me on LinkedIn, found me on LinkedIn. And we have 2 conversations this week to talk about how we can do some things together. It's unbelievable. This is after 40 years. And so I just felt this was the area to be at. And so I would say, here's the one thing I really want to embellish on, is I've always been comfortable in my own skin. I've always felt confident that if it didn't work out, I could find another job. So I always did things the way I felt were right, and never wanted to worry about being fired. Now, it turns out I've never been fired. And because I've always felt I was going to do it right. And if it didn't work, I get a job. And I've always gone to where I felt the action was. And so I felt that was initially semiconductors. Then I had an opportunity to take a chance and get in database software. And I've been in internet, I've been in application software and network security and so forth. The point is, if you really want to get ahead, you need to be comfortable taking risks. And that's how I've been, at least the modicum of success I've had. I ascribe to the ability to basically, in the case of semiconductors, and then I had the opportunity to go to Sybase. That was the only job I've ever gotten to a recruiting firm. And it was a big risk because I'd never been in software. But I knew I had to move from semiconductors, otherwise I would be considered just a semiconductor expert. I find after a few years, if it's not working and I see some better opportunity and I think it's the right time, I go do that. I take the risk. So yes, I might fail. That's always a downside. But you can also easily just fail by doing the same thing over and over again.
I mean, taking risks is one thing, Ken, but it also probably matters a lot about how the brain is wired. I mean, listeners to our show are well acquainted with the engineering background of ICE's founder, Jeff Sprecher, the president of the New York Stock Exchange, Stacey Cunningham, both engineers, University of Wisconsin, Lehigh. You have an engineering degree from Cornell. I came across an interesting stat about engineers as we got ready for this conversation. 75% of trained engineers find a career doing something other than that. Why do you think engineers find success outside of their discipline so often?
The thing about engineering is it teaches you how to think. It teaches you logic. There are many very successful Cornell engineers that are in venture capital today. And, it's a great career because engineering tends to be numbers oriented and finance, which is obviously numbers oriented. Frankly, I remember for me, it taught me a couple of things. One is how to react in pressure, because these tests, all of a sudden you realize there's only a few minutes left and you haven't answered the questions. I also, in engineering school, I was, my first year, I met my roommate, who, by the way, turns out he's from Newton as well. I looked at him, and he had gone to a good public school. I went to not so good, and he was doing great in school, and I wasn't. And I felt that I was just as smart as he was, so it bugged me. And so all of a sudden, my confidence changed, and I started doing much better in school. So getting confidence in yourself, but engineering, because you have to, solve equations and problems, it gives you that confidence factor. And so I think engineering is a great discipline that you can venture from there, so to speak, into a number of fields. Maybe business. I know some people go into law, some people go into medicine, but it's a great proving ground, if you will, for your successive career.
I think, Ken, VSLI was the first company that you brought public as a CFO. The markets in the world were very different back in 1983. Tech companies were in their infancy, and exchanges like the New York Stock Exchange were governed by rules that would not even allow them to list based on not being profitable. What are your memories, and were there lessons that you've used since from those VSLI days?
I actually have a list of lessons learned from each company I've been at. And some of these things that I just don't forget. The first lesson is being in the right place at the right time. I got the job as seventh employee at VLSI as VP Finance, which ended up becoming CFO there because of a contact I had, someone I worked for at Fairchild who referred me in. I was young, 31 years old, and I was referred in and got the job through his reference, which was, basically other than one job, all my jobs have come through referrals. And so the network effect I find very, very important on referrals. That was important. I remember we had a change in CEOs, and I had to make it through that. But here's really the lesson I learned in that particular company is, and I think it's relevant for a lot of companies today, we never got to a really profitable business model. And so as we scaled the company, we kept on scaling expenses pretty much the same rate as revenues. And so I think the challenge for companies today where the market allows you to lose a lot of money initially is that's fine. But do you have a model that ultimately, when you get to, medium, later stage, will allow you to make a good profit? And so I think knowing how the business model works is really important. We were in a custom semiconductor business then, and it was a business that was not inherently able to make good money because when products went into volume, they got second and third source. And when they didn't go into high volume, you couldn't really make any money on it. So it was basically a business model that wouldn't scale to high profits. And so thinking about your business model early was the real key lesson there. After knocking my head against the wall for 8-9 years there, I realized it wasn't the lack of trying. It was the fact that our business model really was not going to be successful.
You've mentioned various folks who you've met, made connections with, helped you along the way. While you were at VSLI Tech, you crossed paths with one of our prior guests on this podcast and the legend of Kleiner Perkins, John Doerr. How did that friendship help your career, and what did it teach you more about the value of making these connections?
We got to know each other pretty well. I then went to Cypress Semiconductor after that. He was on the board of Cypress, so he and I got to know each other more there. By the way, that was a great board. We had Pierre Lamont, we had LJ7, we had John Doerr. Just a great board. I then went to Sybase, which, as I recall, I'm not sure it was KP company or not right now. But then he hired me to At Home Network. in which he was the founding venture guy. I was a founding CFO. The CEO and I came in the exact same time. So I worked there until, frankly, we made an acquisition, and then a new CEO came in, and let's just say I realized that CEO and me didn't agree on how to run the company. And so I decided to leave and went to work for Tom Siebel, had been trying to hire me for a long time. That was not associated with John, and neither was Fortinet. But I've had several times where I worked with John. I've been in all their funds. So Small World is a company I've been sort of helping a little bit called Emerus. And John's a major investor there. And so we've done some good things there. And so I've gotten to reconnect with John. We're good friends. I think that he's as smart as any venture capitalist I know. He's just wonderful. He's a good man. We've been mutually wonderful, I think, to each other, if I can say it that way.
You mentioned Yahoo a couple times, Ken. You helped engineer the sale of Yahoo to Verizon, which is NYSE ticker symbol VZ, in 2017 for $4.8 billion, which is minus the substantial investment in Alibaba and Yahoo Japan that in separate transactions would sell for another $44 billion 2 years later. With the advantage of hindsight, were those exits the best case scenario for a tough spot?
Unequivocally, no. We should have done, which we wanted to do, is we should have spun out the operating business as a public company and spun out the Alibaba as a separate public company, which is what it did. We had a board which, frankly, was not aligned to, unfortunately, we have activists involved, and there are some very, very good activists, and there's some activists that, frankly, just want to muck things up, if I can say it that way. I think if we had spun out Yahoo as an operating business, we would have done, in my opinion, much, much better. Mercer and the team were doing a fabulous job. Take me out of the equation in terms of recreating the business. It was a business we had to get mobile. When we joined there, we had no mobile products whatsoever, so we had to basically change the entire business model to go mobile, which we did, but it took us a while to do that. And yes, can you always do some things better and faster? Absolutely. But I would say the lesson learned there is to really have a board that, you have to be both, and I've heard this over and over again from a number of very astute people, a board that's both independent and collaborative and collegial. And so it's a funny mix, but it's really important to be, I'm not saying you be all one mind at all, but to have a board that works really well together and really supportive of doing the right things. Hey, if you don't like this, if you think the company's the wrong direction, then certainly the prerogative is to move the CEO out and CFO for that matter. But until then, you need to be on the same page. If you don't have a board that really works well together, it really puts a company at a very, very significant disadvantage, a very significant disadvantage. And, I'm very excited with all the boards I'm on. I look at the progress we've made at GoPro over the past year. It's phenomenal in terms of changing a business model. And we were only successful because we had a board that worked really hard with the operating team of the company, and Nick Woodman and team have done a great job. One of the reasons why having dual class stock has been used by a lot of technology companies going public is so they have the wherewithal to run the company in a way that's conducive to what they think makes sense, and not have activists, come in and try to change the mix.
As we begin to wrap up in our conversation, Ken, let's focus just a little bit more on boards. 2 years ago, ICE launched the New York Stock Exchange Board Advisory Council to match public companies that were seeking to diversify their boards with candidates looking to become board members. How should diversity be considered when forming or adding members to a board?
The studies have been very clear that diverse boards, diverse management teams are more successful, do better on shareholder returns than non-diverse boards. So to me, that's the carrot. The carrot is diversity is conducive to better performance. And so therefore is you should create diversity amongst your management team, your employee base, and your board. And I think to measure that is important. It's the old saying, where you measure gets managed. So I'm all for being able to, display that in your proxy in terms of charts to show your diversity of your team. I know in the boards I'm on that, we are very actively looking to increase our diversity. And diversity, by the way, diversity comes in a lot of different ways. Diversity is tenure on the board. It could be how many, 0 to 5, 5 to 10, 10 to 15 years on the board. Diversity is geographic background. Diversity is industry, what industries you've been in, functions you've been in. Diversity is your gender, underrepresented minorities. So diversity covers a number of factors, and they're all weigh on having, in my opinion anyway, a very successful board. Used to be, in the old days, audit did all the work, comp did some work, and non-gov, that's where you had, if you didn't have to do too much, that was where people joined boards. So you didn't have to be too busy. Turns out, with all the rules on CD&A, compensation is every bit as much as hard as audit committee. Matter of fact, I would argue harder, because in the audit committee, at least you have clear rules and regulations that you can assign yourself to or run by, as opposed to compensation, which is much more qualitative, if you will. But non-gov, in terms of the succession planning, in terms of governance and DEI, and ensuring all these things are done well, relative to board recruitment, is now, I'm on the non-gov for NXP, and we have meetings upon meetings upon meetings as we're adding to our board. So yes, I'm answering your question in a way that I like the carrot approach more than the stick. Maybe you need the stick to help out sometimes, but the carrot approach to me on the question you asked is diversity is conducive to better performance. It's all you need to know.
A couple of years ago, you spoke at a CNBC event on how quickly CFOs and their teams are expected to finish the diligence on potential deals. You had this word of caution. I'm going to quote you. Anything that requires me to make a gut judgment call in hours or days, I do worry about someone trying to sell me something. Does technology like what you're now doing at Monsoon Blockchain Corporation or IBM's Watson make it possible to move quickly with all the information you need?
I always hate knee-jerk and I get this all the time. And any job I've been at is knee-jerk. If I don't do this now, we're going to lose this, or this is not going to happen. Blah blah blah. And so yes, I do worry about that. I think it's a little concerning in venture today because there's a rush to because if you don't fund this, XYZ is going to fund it. So there is a lot of that going on today. I still think, by the way, business is funny. You learn a lot on business school on cash flow, DCF, do all these analyses before you make a capital investment, before you make an acquisition. The reality is, unfortunately, and I hate to say this, I'm a finance guy, you can always sort of make the numbers work. Now, do you need to test the assumptions more? Yes. You can do all the analysis you want, but if you're in the business, you need to expand. A lot of it comes to instinctual judgment. I like a term called pattern recognition, where you have a sense of seeing things, you have a good sense of it, that gives you the confidence one way or the other. So I think pattern recognition is really important. I think business judgment, the old saying business judgment rule, I think business judgment is very, very important in how you think about things you do. So while you want to have a set of numbers, and mainly because numbers forces you to put down your assumptions, and so as you come back and review how successful something is doing, you can go back and look at your assumptions and see if they're playing out the way you thought they should or not. So that's really important. But I think ultimately, the business judgment, the pattern recognition you have from your experiences, your intuition, I think those are all extremely important attributes, which is why I'm going to come back to this, why on a company, it's nice to have people that have been around 20, 30 years experience. I mean, you mentioned your prior CFO, I think you said had been there 14, 15 years.
Yeah.
That's a wealth of institutional knowledge. That is wonderful, absolutely wonderful. So, on boards, I'll come back to boards. One of the things that when you get a company that's gone public, a venture-backed company's gone public, as it's going public, primarily all the board members are venture capitalists. Well, over time, they're going to want to spin off because they want to work in their other companies. But the more I can keep those venture capitalists on the board, the better we are, because they have the institutional knowledge of how things were created and organized and so forth. And so that's a real good balance. So to keep them on as long as you can, as you add new board members, to me is a plus versus just assuming you want them all to leave and you want to have, quote unquote, all independent board members. You mentioned John Doerr earlier. He had a saying he would always say, no conflict, no interest. And so, yes, if you're a board member and you're a big investor, yeah, could you say you have a conflict? Yeah, but you have a lot of interest in the company. And so that, to me, that's always great. So anyway, that's how I thought of it in terms of boards and conflict and interest and so forth.
As we wrap up, Ken, you grew up in Peabody, Mass. It's not far from Gloucester. The heritage of the Gloucester fishermen is long and deep. One thing beyond everything that you and I have been talking about at Hillspire is the Schmidt Ocean Institute, working to advance the frontiers of global marine research. One of our recent guests, Jonathan Rothberg, operates a floating lab aboard his ship, the Gene Chaser. Paul Allen, renowned for his work in this area. What's the status of the Schmidt Institute's work? And for a kid who grew up in the North Shore, is it particularly gratifying for you?
Yeah, it is. It's a boat that we have, Falcor. It does all these oceanography studies. It spent recently a lot of time off the coast of Australia and New Zealand. It's an area that our principals have a lot of interest in. They've done a lot of work on seabeds and coral and and plastics and so forth. We have wonderful people there. That's one of the benefits I've had in this job is the people I've gotten to meet. The person running that operation, she's phenomenal. We did a long search for her. It took us like 8 months to hire her. We found the best of the best. And we do really interesting research-oriented work. Much of it is effectively nonprofit. It's a fact that the principals have the wherewithal to do something like that because of their collective success. We have some very, very smart, dedicated, passionate people who believe in our mission. And that's really what you want to have in any enterprise. It turns out I'm on a number of nonprofits. An example is RFK Human Rights, run by Kerry Kennedy, which is working on the legacy of Robert Kennedy.
Yep.
I'm on a board of Peninsula Humane Society because I happen to be an animal lover. I'm on SASB, which happens to be creating ESG standards and metrics. And so I applaud these, so SOI, which you mentioned, is effectively a nonprofit, doing a lot of oceanography work. I applaud people that are doing this work. They're purposely mission-oriented and passion, and I applaud those people. And I am, so pleased and honored, frankly, to be involved in these kinds of organizations. I don't like to use the word giving back. It gives a sense. Someone says, like, I have to, because I was taking before, so now I'm giving back. And I don't like that term. You actually mentioned earlier about family offices. I and many others have the wherewithal and opportunity to do well, and I think, the thing, I'll just sort of digress a little bit here. And my wife and I have talked about, yes, we give a lot to, on a relative basis, to institutions that supported us, whether it's our respective universities, whether it's, my wife is in medicine, so whether it's various hospitals. On the other hand, giving more to thinking about how to help people that are in need, not just from the pandemic, but just in general. How do we think about inequality and helping people? I'll leave on this because it really means a lot to me. People want the dignity of a job more than, for the most part, more than the handout. So how can we create a thriving economy in which people have the ability to get dignity of a job? Housing, it used to be 60, 70% of the people in this country had at a home. They don't today. How do we get homes for people? I would hope that we can find a way to get away from all of our partisanship and find a way on both sides. And so I think both sides would follow, said that way, to get to where we can get people, where we really help the people in need. So to your question about family offices, that's another area where I think family offices will play a big part. There are many families that have been very fortunate, and I think you will find many of them coming out and really helping folks that need the help there. Better spent money than a lot of the government money being spent. So anyway, that's I'm just giving you my own opinion, but that happens to be my opinion.
And on that note, we'll leave it at that. Ken Goldman, thanks so much for joining us inside the Ice House. Well,
thank you. You've done a lot of research on me. I congratulate you. You brought back some good memories of different places where I have spoken. So, the spontaneity of being able to talk like this, I enjoy because I don't have to do a PowerPoint. And I find it much more interesting and sort of hopefully helpful.
Well, maybe our next meeting will be on board the Falcor.
That sounds great. Thanks, Josh.
Thank you so much. That's our conversation for this week. Our guest was Ken Goldman, President of Hillspire LLC. If you like what you heard, please rate us on iTunes so other folks know where to find us. And if you've got a comment or a question you'd like one of our experts to tackle on a future show, email us at icehouse@ice.com or tweet at us at IceHousePodcast. Our show is produced by Pete Ash with production assistance from Brian Hopkins and Ian Wolfe. I'm Josh King, signing off from the Library of the New York Stock Exchange. Thanks for listening. Talk to you next week.
Information contained in this podcast was obtained in part from publicly available sources and not independently verified. Neither ICE nor its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the information and do not sponsor, approve, or endorse any of the content herein, all of which is presented solely for informational and educational purposes. Nothing herein constitutes an offer to sell, a solicitation of an offer to buy any security, or a recommendation of any security or trading practice. Some portions of the preceding conversation may have been edited for the purpose of length or clarity.